Welcome back to the Deep Dive. It is Thursday, February 5th, 2026. And I have to say, looking at the financial headlines this morning, it feels like, it feels like a moment the Indian market has been holding its breath for. We are finally talking about the IPO of Fractal Analytics.
It is a massive week. I mean, we are looking at India's first pure-play AI unicorn finally hitting the public markets.
Which is just wild when you think about it. ChatGPT came out, 3 years ago?
Yeah.
The whole world's been losing its mind over AI, stocks have gone vertical, and yet here we are in 2026 seeing the first Indian unicorn in the space actually list. It feels a bit...
Late to the party.
Yeah, late to the party. Or maybe just fashionably late.
I'd go with fashionably late. And probably a bit more responsible when you actually, look at the prospectus. This isn't a company that just slapped .ai on their website last week.
Right, and that's exactly why we're doing this today. Our whole mission here is to look past the AI sticker shock.
Right.
We've got the red herring prospectus, the financials from FY25 and the first half of 26, founder interviews. We have to answer the uncomfortable question. Is this a solid business backed by real cash flow? Or is this just riding the absolute tail end of the global hype cycle?
That is the trillion-dollar question, isn't it? Because if you just skim the headlines, you see unicorn, you see AI, and you might just assume cash burn. But Fractal is a very different beast.
Okay, so let's get the logistics out of the way for everyone listening. The IPO opens this coming Monday, February 9th. The price band is set between 857 your have and 900 BQT per share. So if you're looking to bid, that window is opening up now.
And before you push that button, we really need to strip away the buzzwords, because there are a lot of them in this document. Agentic AI, decision intelligence. We need to see if there's a real business underneath all that.
Oh, stick a pin in the agentic AI, because I definitely want to ask you about that later. It sounds like something out of a Terminator movie. But let's start with the money. The IPO structure. Usually we see two pots, right? The money going into the company to build stuff.
And the money going to the early investors who are, cashing out and buying islands.
Exactly.
Yeah.
What's the split here?
So you have the fresh issue and the offer for sale, the OFS. The fresh issue, that's the money actually hitting Fractal's bank account for growth, is roughly 1,023.5 crore.
Okay.
But the offer for sale is significantly larger. It's about 1,810.4 crore.
Whoa, hold on. So nearly 64% of this IPO is just existing investors heading for the exit.
Correct.
See, that's where I get skeptical. If I'm a retail investor and I see the big private equity guys selling nearly double what the company's raising for itself, isn't that a classic red flag? It feels like they're dumping the stock on us at the peak.
In a vacuum, yes, absolutely. A high OFS is often a signal that the smart money thinks the best days are behind them. But, and this is why you have to read the fine print, context is everything here.
Go on.
The big sellers are TPG and Apex partners. They've been invested for years, so taking some profit is normal. But here's the twist that changes the whole narrative. They drastically reduced the number of shares they're selling.
Wait, they decided to sell less than they planned.
Much less. TPG slashed their sale size by something like 78% compared to the draft papers.
Why on earth would they do that? If they want out, why not sell?
Because they hate the price. And this brings us to the whole drama of this valuation. In their last private funding round, Fractal was valued at around $2.4 billion. But at this IPO price, the market cap is somewhere between, say, 1.6 and 2 billion.
Ouch. That's a down round. They basically lost $1 billion in value. That's not a haircut, that's a decapitation.
It looks bad on paper, right? But think about it like selling a house. Imagine you own a house you think is worth $2.4 million, but the market's soft and buyers are only offering 1.6. Do you sell the whole house?
Yeah, you wait.
Or you sell the spare bedroom to get some cash, but you keep the rest of the house because you believe the price will come back up.
I see. So TPG and Apex are saying, we aren't selling our main stake at this bargain price. We'll wait.
Exactly. By refusing to sell their full quota, they're actually signaling a massive vote of confidence. They are betting the public market will eventually value the company higher. If they thought this was the peak, they would have sold everything they could, price be damned.
That's a fascinating psychological signal. Okay, so let's look at the cash that's going into the company, that 1,023 crore. Are they building a giant server farm, a robot army?
Well, it's a bit more mundane. A decent chunk, about 265 crore, is going to Fractal USA to pay off a term loan of roughly $32 million.
Really? We're excited about an AI IPO so they can pay off a bank loan. That feels incredibly underwhelming.
It's not sexy, I'll grant you that. But look at the interest rate environment we're in. Clearing that debt off the balance sheet immediately boosts their bottom line. It's just good governance.
Fair enough.
But they aren't just paying bills. They've allocated 355 crore specifically for Fractal Alpha, that's their innovation engine, for R&D and sales.
I also saw a line item in there that made me laugh. They allocated 57 crore specifically for laptops.
It sounds trivial, doesn't it?
It sounds like they're stocking a Best Buy. But seriously, what does that tell us? I thought AI was supposed to replace people. If they're buying thousands of laptops, they must be hiring thousands of people.
That is the critical realization. Fractal is not a pure software company where you write code once and sell it a million times. It is a human-in-the-loop business. They have thousands of data scientists, engineers, behavioral experts. The laptops are a tangible reminder that this business relies on brain power, not just server power.
Okay, that's a perfect segue. Let's talk about what those thousands of humans with new laptops are actually doing. Because data analytics is such a generic term. My fitness watch does data analytics. What is Fractal actually selling to a company like Google or Visa?
The founders, Srikanth and Pranay, they describe their mission as decision intelligence.
Okay, I'm going to stop you right there. Decision intelligence sounds like something a consultant made up to charge double the hourly rate. How is that different from regular old analytics?
It's a valid skepticism. The difference is in the approach. They call it decision backward. Most tech companies start with the data. They say, here's a terabyte of sales data, let's make a dashboard and see what happens.
Right, the look at the pretty charts approach.
Exactly. Fractal starts with the decision. They ask a CEO, what is the one decision you have to make today that costs you money if you get it wrong?
Give me a real-world example.
Okay, take the example of a global food group from their prospectus. They were having a massive issue with waste. They were making too much of some products, not enough of others, because their forecasting was just too generic.
So they're guessing.
Essentially. Fractal came in, but they didn't just look at sales history. They built an AI engine that looked at local demand factors, weather, events, hyper-local trends, all of it. They aligned the manufacturing decision to that granular demand. The result was a 15% reduction in waste.
15% for a global food giant is hundreds of millions of dollars.
Exactly. That's not just a dashboard showing waste is high. That's an engine that tells the factory manager, stop making product A, start making product B. That's decision intelligence.
Okay, I buy that. But here's the thing. Lots of companies do analytics. Accenture does this. Deloitte does this. What is Fractal's moat? What stops a bigger competitor from just crushing them?
This is where it gets really interesting. Their moat isn't just code, it's psychology.
Psychology.
Years ago, they acquired a firm called Final Mile. It's a behavioral science company. See, most AI engineers assume humans are rational. If I show you data that says smoking kills, you'll stop smoking.
Which, as we know, is absolutely not how humans work.
Correct. We are irrational, emotional, messy. Fractal combines its AI with neuroscience to actually account for that.
How does that apply to business, though?
There's this brilliant case study about a bank. The bank was trying to manage risk in its loan portfolio. Standard analytics just looks at credit scores and payment history. It's binary. You're good or you're bad.
Right.
Fractal used behavioral science to segment borrowers based on their relationship with debt, and they identified this group they called stressed jugglers.
Stressed jugglers. I feel like I know a few, though.
We all do. These are people who want to pay but are overwhelmed. If the bank uses a standard, aggressive collection script calling every hour, threatening legal action, these people just panic. They shut down, they stop answering the phone, they default.
So the standard approach actually breaks the customer.
Exactly. Fractal's model identified these people and told the bank, don't threaten them, nudge them. They used gentle reminders, a helpful tone, flexible options, and the repayment rates for that segment just skyrocketed. A pure tech competitor would never have seen that human nuance.
That is genuinely cool. It's like therapy at scale.
It is, and that integration of design and behavioral science is hard to copy. You can't just hire a bunch of coders and replicate that culture.
Okay, so that's the secret sauce. But let's look at the structure of the business itself. You mentioned earlier they have two engines.
Yes, and this is crucial for understanding the stock. Engine 1 is Fractal.ai. This is the cash cow. 96% of their revenue comes from here. This is the services, business consulting, custom AI solutions for the Fortune 500s. It's profitable, it's steady.
But services are hard to scale, right? To double your revenue, you usually have to double your employees.
That's the limitation, which is why they have Engine 2. Fractal Alpha.
The Moonshot Factory.
Ideally, yes. Fractal Alpha is a collection of product businesses. These are software platforms, build it once, sell it a million times. The margins here are massive, nearly 70% gross margin.
And the star here is Quero.ai.
Yes, Quero.ai. It's their healthcare imaging AI. It reads X-rays and CT scans to detect things like TB, lung cancer, strokes.
Is this actually being used, or is it just a research project?
Oh, it's very real. It's been used on over 25 million scans globally. And most importantly, it has FDA clearance. Getting FDA clearance for an AI algorithm is incredibly difficult. That's a massive regulatory moat.
But Fractal Alpha is losing money right now, isn't it?
It is. It's loss-making because they are pouring money into R&D and sales to capture market share. But this is the bet you're making as an investor. You buy the IPO for the safety of the services business, but you hold it for the lottery ticket potential of the product business.
Let's talk about that term you mentioned in the intro, agentic AI, because frankly, it sounds like pure marketing fluff. How is that different from what Queer or the services arm is doing?
It's the next evolution. Think of the current AI like ChatGPT as a really smart librarian. You ask it a question, it summarizes a book for you. It's passive.
Okay.
Agentic AI is like hiring an executive assistant. You don't just say, summarize this report. You say, book me a flight to London, find a hotel under $300, and email my itinerary to my wife. The AI has agency. It takes action in the real world.
So it's not just generating text, it's executing tasks.
Precisely. And Fractal is pivoting hard towards this.
Right.
They believe the future of enterprise isn't just dashboards, but AI agents that can actively manage supply chains or customer service workflows without a human having to click approve every time.
That sounds lucrative, but also terrifyingly complex to implement. Let's ground this back in the numbers. You call them a unicorn, which in startup land usually means burning cash like a bonfire. But the FY25 numbers look different.
This is the turnaround story. If you looked at FY24, they posted a loss of roughly 54.7 crore. It looked like a typical growth at all costs company.
Right.
But in FY25, they swung to a profit of 220.6 crore. That is a massive delta.
How did they do that? Did they fire everyone?
No, headcount is stable. They achieved this through what's called operational leverage.
Break that down for us.
Think of it like a restaurant. You have fixed costs, the rent, the kitchen, the staff. The first 100 burgers you sell, just pay for those costs, you make zero profit. But the 101st burger, that is almost pure profit because the rent is already paid.
I see. So Fractal hit that point where their revenue grew enough to cover the rent, and now the extra revenue is flowing straight to the bottom line.
Exactly. Their revenue grew nearly 26% to over 2,700 crore, but their costs didn't grow nearly as fast. Margins jumped from about 4% to over 14%.
And are these real profits, or is it some adjusted EBITDA magic?
Profits are opinions, cash is fact. I always look at the cash flow statement. In FY25, their operating cash flow was 397 crore. They are generating cold, hard cash.
That is refreshing. So they can fund their own R&D without begging VCs for more money.
Exactly. They spend about 6% of revenue on R&D, and they're funding that internally. That is a very healthy sign.
Okay, I'm feeling too positive right now. I need to be the wet blanket. What is the risk? What kills this company?
The biggest risk is staring us right in the face in the RHP, client concentration.
Give me the number.
The top 10 clients contribute 54% of their revenue.
Oof. More than half the money comes from just 10 customers.
Yes. Now, these are clients they've had for an average of 8 years. They are sticky. But imagine if one of those clients is Google or a major bank, and a new CIO comes in and says, I don't like Fractal, I want to use my buddy's firm.
That's a 5 or 10% hit to revenue overnight. The stock would crash.
Exactly. If one of those giants sneezes, Fractal catches pneumonia. That is the risk you accept with this stock.
So, weighing the profit against the concentration risk. Let's talk valuation. Is it expensive?
At the 900 rupee price point, the PE ratio is, well, it's complicated because they just turned profitable. But if you look at the valuation relative to revenue, they're asking for a valuation of about $1.6 to $2 billion.
How does that compare to, say, Palantir? Everyone loves comparing AI stocks to Palantir.
That's the trap. Palantir trades at a massive premium, sometimes 20 or 30 times revenue because it is a pure software product. Fractal is still 96% services. And services companies like Accenture or TCS trade at much lower multiples because they're labor-intensive.
So Fractal wants a tech valuation, but they have a consultancy business model.
That is the friction. They're arguing they are in the sweet spot, more scalable than Accenture, but more hands-on than Palantir. The fact that investors like Apex and TPG cut their sell down suggests they believe the market will eventually give Fractal that higher tech multiple, especially if the product side grows.
It's an arbitrage play. Okay, final piece of the puzzle. The people running the show. Management and governance.
This is a highlight for me. Srikanth Velamakanni and Pranay Agrawal, they founded this company in 2000.
Wait, 2000, so they survived the dot-com crash.
They survived the dot-com crash, the 2008 financial crisis, and a really nasty boardroom coup in 2007.
Oh, spill the tea. What happened in 2007?
The investors back then wanted to bring in a professional CEO. They thought the founders were just tech nerds who couldn't scale a business. There was a standoff. Srikanth basically said, "I'm taking charge," and the founders refused to step aside. They pivoted the company, fixed the issues, and proved the investors wrong.
That takes some serious backbone.
It does. And here is the ultimate proof of their conviction. In this IPO, while TPG and Apex are selling, the founders are selling 0 shares.
Nothing.
Yeah.
Usually this is the part where the founder buys a yacht.
Not a single share. They own about 10% combined, and they are holding on to all of it. Srikanth has a quote about building an institution that lasts 100 years. By not selling, they're putting their entire net worth on the line. They're telling you, we think the stock price is going up.
That is the ultimate skin of the game.
Yeah.
You can fake a press release, but you can't fake holding onto your stock when you could cash out for millions.
Exactly.
So let's wrap this up. We have a 25-year-old startup that's finally profitable. They have cash flow. They have founders who are all in, but they are dealing with heavy client concentration and a business model that is currently trying to be 2 things at once.
That's the summary.
So for the learner listening to this, trying to decide if this is a buy, what's the final thought to chew on?
The provocative thought is this. Fractal is fighting a DNA war. They are a services company trying to become a product company.
And those are very different cultures.
Complete opposites. A services company is built on saying yes to the client. You want a blue button, we'll build you a blue button. A product company is built on saying no, that's not on the roadmap.
Right.
Can they maintain this hybrid model? Or will the services culture eventually stifle the product innovation? History shows it is incredibly hard for consultancies to build great software products. Fractal is betting they're the exception.
So the homework assignment for our listeners, don't just look at the top-line revenue in the next quarterly report. Look specifically at the Fractal Alpha revenue.
Yes. If that line starts growing exponentially, then this isn't a consultancy anymore. It's a tech giant in the making. That is where the multiplier lives.
I love that. We'll be watching the listing on Feb 16th to see if the market agrees. That's it for this deep dive into the Fractal Analytics IPO. Thanks for sticking with us, and we'll catch you on the next one.